Hi, everyone. This is Jason Bjork of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest, but I've been following his work for years. I originally found him on the Financial Sense program with Jim Poplava. He's had him on there many times to talk about the oil, natural gas, and energy markets. He's an energy law and finance professor at SMU. He's been teaching about the oil and gas industry and the laws for 30 years, and he's also an energy fund manager. Thank you for joining us, Joseph Dancy.
I appreciate it. Thanks for having me on.
Now, Joseph, you cover the oil and gas market extensively, and you also manage money in the for oil and gas. Why, in your opinion, did the oil prices drop so much so quickly?
Well, you look at, Jason, just the market supply and demand, and it's really sort of surprising. I don't think you can explain the severity of the drop that we've had just based on supply and demand. I mean, if you look, for example, almost every year, for the last 20 years, demand for oil goes up by about 1 million barrels per day. Today, we use around 90 million barrels per day, 90 to 95, so it's 1% per year increase. So if you look at the demand estimates by like the International Energy Agency, which is sort of the guru of forecasting, they have predicted, and actually they reduced their demand forecast from 1.1 million barrels per day for next year increase to 0.9 million barrels per day increase. Of course, everybody, this was in earlier December, everybody sort of blows a circuit and, the price of oil goes down $2 or $3 a barrel. And, hey, look, we are going to have this year in 2014 record demand for oil globally. If we increase by 0.9 million barrels or 1.1 million barrels per day, next year we're going to set another demand record for oil. And it's interesting, Jason, we're not seeing the demand growth in Europe or Japan or the United States. Except for the United States, those economies aren't doing so well, and in the U.S. we've become more energy efficient. Where we're seeing the demand increase is in developing countries whose economies generally have been a little bit more robust, including India, China, some of the Asian countries, et cetera. So it's not really a demand shortfall. And you look at everybody, well, we're running, supply is sloshing oil down the streets of Texas or Oklahoma, but if you look at some of the data, actually the inventories are not grossly out of line. In fact, if you go to Cushing, Oklahoma, I remember a few years ago, people were saying, the Cushing, the huge, just dozens of these huge tanks were full of oil when they had the super contango. You could store the oil and then sell it a year later in the futures market and make a killing. And they actually had airplanes, they'd fly over because they had the floating roof tanks, and they could tell how high or how low the storage was there. And they had special reports, and my students were I was telling them about it and showed them some articles, and they were, wow, is that, I said, well, when you're dealing with, multi-million-dollar investments, it takes, that is information that's incredibly valuable. But if you look at the supply and the inventories, they're not super high. If you look at the supply, of course, everybody, we're increasing shale production in the United States. And, we are. We increased the last couple of years shale production by about 1 million barrels per day, mainly from the Bakken in North Dakota and in the Eagle Ford down here in Texas. I'm a Texas boy and work out of Dallas, but the interesting thing with regard to the shale oil is, number one, it really is all black crude oil. A lot of it is liquids, which is counted as oil, but it's not really oil. And actually, the characteristics of the crude is such that in some cases refineries that have been set up here in Texas and Louisiana and elsewhere, which is the refining belt down on the Gulf Coast, they've been set up to take much heavier oils from Venezuela and elsewhere. So we may have somewhat of a glut there of supply. But the interesting thing is the the shale wells, as you know, decline substantially, 70% roughly in the first year, and another 50%. So if you're drilling a well, this is so cool for finance students, because you look at the cash flow and you do your cash flow analysis, and you invest $8 million in a well, and then you use the type curve, decline curve, and put in your price deck, and you can tell, show investors that, gee, for this well, we can get a X, rate of return, and we'll either drill it or not. And of course, that analysis. So essentially, the oil prices over the short term, the next 24 to 36 months, really tell you whether you're going to make money drilling a shale well or not. And if you look at the current prices of oil, it's like, well, you put in $100 or 90 or 85. I mean, generally the one people I'm familiar with were using 80 or 85 here about a year ago. Now you put in the current prices, and a lot of those wells we drilled that were economic, and actually they will net back, and actually they still are probably economic to drill based on hedging programs. A lot of those wells are not economic now, so they won't be drilled, and they decline so fast. I think what's going to shock people is how quickly our supply of this shale oil declines in the United States. It was going to decline anyway. It was going to peak here in a year or two based on the U.S. EIA as well as the IEA out of Europe in 2017, 2018, 2019, just because we're on a treadmill where you drill the wells, you get a great flood of oil coming out of it, but they decline so quickly you need to keep drilling to keep the production gaining. And all the forecasts, including BP's, said the U.S. shale oil. So I guess to answer your question, I mean, I have a hard time figuring out, based on supply and demand, how oil can go from $100 or $105 to the current price today, which I don't have my Bloomberg in front of me, but do you know the price oil, roughly what it's trading for this week?
It was WTI, I think, was around 60. I think roughly yesterday. There was a little pop. I'm not sure what it did today. But, I agree with you there. The supply-demand fundamentals, Joseph, did not justify this price movement, especially so quickly. So to me, then, at least, either there was too much leverage in the system. People were, buying paper oil contracts on heavy margin or something like that. Or in the oil derivatives market, there was crazy gains. Or maybe it was some type of combination where, the Saudis were asked by the U.S. government and Wall Street, and it was a coordinated attack to go after the Russian ruble and then to knock down the oil price in the paper markets. Because as you just mentioned there on the supply side, we're getting to the point here where it's not economic to drill any of these wells. And we keep hearing, these Wall Street people, these traders saying that the paper price of oil could go to 30 now. Well, if the paper price of oil goes to 30, as we saw in 2009, it's not going to stay there very long, in my opinion.
And I agree 100%. I mean, I think if you look at the price curve, I think, we've fallen off a cliff, and I think it will recover quickly because, I mean, you just look at the companies this is a great time of year for this to happen because the companies are looking for next year's capital expenditures, and what they do is they just put a lot of their projects on hold. A lot of this acreage, Jason, is what's called held by production, which means you buy a lease. If you drill one well on it, generally that lease will be held as long as that one well produces. You can also drill, 100 more wells on the same lease, depending on spacing restrictions and et cetera. But so what companies will do is say, well, we'll just let the Smith number 1 well, we drilled it, it's held by production. The Smith number 2 through number 10, we were going to drill next year, but we'll just push it out, a couple years in the future, and there's no harm there. And if you run the economic model, the interesting thing is, you put in $60 a barrel oil in these models, the cash flow models. I mean, clearly these wells, a lot of them are not going to be they're not going to meet the rate of return required by companies to invest millions of dollars. So as you know, they'll push the development out into the future, and I'm be very curious to see, and I predict, off the top of my head, I really haven't done a bunch of studies, though I have talked to some industry engineers about this, and there's sort of an agreement that the supply response in the United States anyway is going to be quicker than many people expected and probably more severe than many people expected on the supply basis, which will probably, and this is not good for the energy market or the economy, we'll see oil, instead of diving from 100 to 60, rocketing upward. God only knows, where we will go if the global economy continues growing, which everybody says it will. And of course, I have some concerns about Europe, and obviously now with the Russia issues, God only knows what contagion impact. But I can tell you, we have seen the end of cheap oil. You can't really go out and develop fields at $50 or $60 a barrel. You can, some of them you can, but a lot of the cutting edge shale plays, even though we're getting much more efficient, we're drilling multiple wells off a single pad, where not only is it environmentally more advantageous because you don't have 16 drill pads and you have one pad and 16 wells that you drill in all sorts of different directions, but essentially the concept that we're not going to see much of a response here is, I think, mistaken, and I'm sort of concerned that in 18 or 24 months we aren't going to see the exact opposite issue occurring, where we have a wild boom time when I've seen I've been in the business when when I first got in the business, it was a big oil boom, and I was in Oklahoma, and there was a English teacher. He was a junior high English teacher, quit his job and started a oil company, and he made a killing for 6 months, and then 6 months later he was bankrupt. But you were so impressed because he was doing all these trades, and of course you can do that when the price of oil or the price of gas is on a moonshot. But it creates instability, and also with regard to capital allocation decisions, when you have this instability, it makes it very difficult to model. It makes it very difficult to convince management or your investors that, look, maybe we ought to, drill a few more wells or not. The uncertainty adds the risk, which was reflected, I think, in the market in some of the commentary. And I can't say, I've been on a half dozen or more calls with some major oil analysts or analyst firms in the last 2 or 3 weeks, and a lot of the folks, they really didn't see this price drop coming, or if they did, they didn't see it to the extent.
Almost no one did. After going back through people's research and stuff, I think Porter Stansberry was one of the only people that I saw whose work predicted anything like this. Really.
Yeah, and really, so you look at it, and it's of course now what they're saying. Last Friday I had lunch with some people here in Dallas at SMU, actually, at an energy luncheon, and I won't name the firm, but they said, hey, you can put on $65 price deck for oil from now till 2020. It's like, aren't you a little bit glum? He said, no, that's really what the price deck they're using now versus. I didn't even know. I didn't even ask him what his other price deck. I was 75 maybe for the next year or so, and then escalated. But prior to this, but like I say, you put in your model. It's such a capital intensive industry. You're talking millions or billions of dollars, and as you noted, it's when you have this volatility, you got to wonder what type of losses are being hidden or might surface when you have such a drastic drop from $100 a barrel or so in July to the current price level, and you have derivatives, you have all this debt that's been put out there. And I did see the Financial Times did mentioned this earlier this week. They had an article that said, a number of banks, these are major banks, that had gone out and syndicated some of these debt offerings for the, I won't say junk bonds, but the less investment grade type of bonds for energy development. They said some of those did not sell, or they couldn't, so they kept them. They actually held them, and essentially at current prices, if they're going to have to mark those to market, and the losses could be substantial. And the market has not focused on this, and these are, I won't name the bank names, but I mean it's a Financial Times article. If you do a search on the Financial Times and just oil prices and mark the market, you'll probably find the article. And it's somewhat disconcerting. And when you see that type of potential disruption to our financial system, it might explain why the price of oil is at $60. It's because you got to say, well, God, maybe demand is really going to be impacted. How could it be impacted? Well, if we have another type of financial crisis with derivatives, or the other big issue is the fact that a lot of developing countries, companies in developing countries, price their debt in U.S. dollars. And if you've noticed, the Financial Times last week also had an article that was on a front page article that said, essentially the developing countries index, and I think it was J.P. Morgan's index of these currencies, hit a 14-year low against the dollar. So if you're a company, you went out, you floated, debt, regardless how much, and the fact that the currencies are getting weaker against the dollar, essentially what it's doing is it's tightening. It's making your ability to pay the debt more difficult, which may result in a slowdown of, you're going to allocate capital to debt versus capital to expansion. So that may explain, some of the potential weakness also in what may be perceived demand going forward. And just the dollar is so darn strong because the United States is really the only developed country where our economy is growing versus Europe. I mean, the Greece crisis is raising its head again, and then you have Russia and Ukraine, and God only knows. I mean, over there, it's going to impact their economy, and then you have Japan, which they've done a surprise easing, and Europe has talked about doing a surprise easing, or do some type of easing in January or February if the Germans will allow the political machine to move down that path, which when you have those banks talking about easing, then you have our United States Federal Reserve talking about tightening because our economy is so hot, and it makes the dollar even stronger, which makes the hill that the debt that is being paid off that is based on dollars all that much steeper. It creates some shudders, and I think that's why you're seeing some volatility, and it's certainly concerning to me. I don't know where the wreck is going to be. I guess it's sort of like you're driving home in rush hour traffic, and there you have 3 different highways to take, and you're just afraid, in the rain that someone might have an issue and tie up traffic, but you don't know until you really get out there. And I think we will see in the first quarter, we will see some unintended consequences of this oil drop, and it may impact the economy. The extent to which I don't know, but that may be driving some concern also with regard to oil prices and future oil prices.
Yeah, there's the potential there for Arab Springs and some of these OPEC countries, the ones who don't run, who have as many surplus dollars and other holdings as the Saudis do. So people like Venezuela, Iran, Nigeria, these countries, they don't keep as much reserves, as much of their trade surplus. They spend the money they want to borrow. They spend almost all their oil money. They want to borrow more. Mexico, I think, stupidly hedged their oil production at like $70, $75 a barrel, almost all of it, which is kind of ridiculous considering, they could have hedged it at a much higher price. So, we've also seen enormous announcements of investment banks that cover energy coming out announcing CapEx cuts. So the global projected capex, I think, for 2015 was supposed to be $720 billion with a B for that year globally for oil, natural gas, those types of investments to find more supply, bring more online, et cetera, et cetera. But I think over 150 billion is already projected to be cut, and we've just seen, larger and larger cuts. I mean, there's going to be long-term ramifications for that. So for people to think that there won't be any more volatility, that $65 price deck that you mentioned, that's ridiculous. You've been through more cycles than me, Joe, up and down in commodities markets. I don't think it's sustainable for maybe in the short term prices do go lower, but I don't think it's sustainable at all for prices to stay this low. OPEC can't, and the national oil companies, they can't have prices this low. The shale oil producers, who were basically the entire marginal demand, marginal supply, side of the global production growth for oil. Really, no one on the planet outside of the U.S. shale oil producers has been growing their oil production meaningfully since 2008. So I don't think any of the and then the deep water drilling has basically slowed down and or almost stopped. So for all these things to get back going again, the oil price is going to have to go higher.
Yeah, I agree with you, Jason, and I do. You mentioned here just some wild cards with regard to the Arab Spring, which has turned into the Arab Winter. Venezuela is not part of the Arab, but part of OPEC. One of the issues, they're probably my main concern right now as a sort of an energy analyst, and one of the concerns is their crude oil is not really high-quality stuff. In fact, it's pretty poor quality crude, and a lot of the stuff coming out of the shale plays in the United States is much lighter, much better crude, much lower sulfur levels. But unfortunately or fortunately, for years, the refiners on the Gulf Coast, down in South Texas and in Louisiana, have a lot of those refineries are set up to run on the poorer quality crude, and you look at their returns. It's one's a function of the cost of the crude, and the other's a function of the product that you can sell. But the problem they may have if Venezuela melts down, and I expect something to happen there significant, whether it's a default only or whatever. I just don't know. But if exports should be interrupted from Venezuela to the Texas refiners, it may put some of those refiners in a sort of a jam, because even now they can mix a little bit of the better quality shale oil with the heavier, lower quality Venezuela crude, but they're really limited there, and they may have to re-examine where they get their feedstock from, and I'm not quite sure where they would go past that if Venezuela actually had some major issues, and I fully expect in the next 6 months Venezuela will have some major issues. They can't operate. They had issues at $100 a barrel, Jason. When it gets down to 60.
Well, they're communist. They're a communist socialist country. Eventually they're going to collapse, period, because they're not allowing any investment or job growth or value creation in their economy. The communism and Marxism and all that stuff is just based off of theft and taking other people's money and redistributing it at the barrel of a gun. So, not to go off on a rant, but
but I would, and I'm sure if you went down and looked at the technology and actually some of their refiners as well as their producing facilities, I guarantee you the capital expenditures have not been made that should have been made. And I would bet their infrastructure is just in a super sorry state. But that's like you say, sort of off topic.
Yeah, I've heard the same thing about their infrastructure. I think their refineries are dangerously decrepit there. They've not been reinvested there for safety precautions and things, so they could have a refinery accident down in Venezuela, which would completely cripple their oil industry, and that's their whole economy is basically relying on that because there's no job creation or anything like that meaningfully in that country anymore. There's shortages of rice, beans, toilet paper, electricity. Their politicians are like stealing from shop owners and handing out like free computers to people, so the poor people, so they don't and the shop owner gets screwed. So it's a disaster down there. They're going to eventually have to go back to free market and capitalism. China and the Soviet Union learned that it doesn't work being Marxist and communist.
It'll be interesting to see where they go. I just from an oil standpoint, and as you know, Nigeria has similar issues. Iraq, probably Iran. Libya's already melted down. I mean, Lord, I couldn't believe, and I think part of the reason possibly that some of the panic set in the oil price market was when Libya came back online. I don't think anybody thought, after the production got cut back so severely, and there's still have an ongoing essentially civil war going on there, that people were shocked at how much oil supposedly was being exported out of the Libyan terminals, but apparently that has all been pretty much shut in again as the fighting resumes. So I don't expect Libya to export much over the next year. And Lord only knows. I mean, Jason, the people don't understand either. When you have an oil field or any type of processing facility, I mean, you need to have continual capital expenditures to maintain those facilities and maintain that production. And you have to go work over the wells, re-acidize, get the paraffin wax out and use paraffin solvents to open up and I guarantee you, in a lot of the areas in Libya, no one's going to put any capital expenditure in just because you don't know. I mean, you don't know what your return's going to be, and quite frankly, any engineer in their right mind is not going to go, to work on an oil field in a war zone. And I mean, the same thing goes in parts of Iraq and parts of Syria, for that matter. It's not a good situation. Actually, parts of Nigeria, it almost seems to be melting down to a certain extent. So when you don't put in the capital expenditures, generally your wells decline, your ability to export declines, and unfortunately, your total returns and your recovery is also reduced, and you waste by leaving oil in the ground that maybe you should have recovered or have it spilled or lost, where it could have been used for something functional.
Yeah, and this lack of capital, whether it's put in by national oil companies like you mentioned, Venezuela or others, we have depletion rates in the legacy fields like Cantarell and Ghawar, I believe, and the North Sea. They've been depleting, I believe, at 4 or 5% per year. Basically, the supply-demand statistics I've looked at, Joe, it seems that a lot of this U.S. shale oil production, as impressive and amazing as it's been to offset the global supply declines, it's basically just treaded water for the global supply. It's kept the global supply essentially flat. It hasn't drastically increased global production like other people anticipated, and there's a lot of reasons why this shale revolution, although now it may not be a revolution if prices stay low enough and some of these companies go bankrupt, but it was at least a revolution for a number of years, why this is not exportable rapidly to a whole bunch of other countries with shale deposits like Argentina and Poland and things like that.
Yeah, let me just jump in there, and this is something, and I really didn't think about this until 4 or 5 years ago when we started drilling the Barnett Shale up here in Fort Worth. They found this, Lord help him, George Mitchell. I mean, if you read some of the books, and he was crazy, and I think most of the major oil companies, missed the shale plays because they said there's no way you're going to get a productive well drilling into the lack of porosity and everything else. But one of the things we have, and why the shale plays have been so exciting for investors and for our economy in the United States that almost nowhere else in the world has, is we have private mineral rights, meaning the landowner, when they got the grant from the United States, actually got title to the minerals, which include oil, gas, gold, silver, coal, iron. You go anywhere else in the world, you go to Russia, you go to Poland, you go to France, you go to, I think, Australia, you go to China, you go to Venezuela, South America. There the government owns either all or substantial parts of the minerals, which means to get minerals developed, you have to deal with government entities to get a lease or get a right to drill. If you're a private entity, taking risk with your own capital and your own property rights, you're much more motivated to develop property than, for example, in Argentina or Colombia or elsewhere where you're drilling and you go to the government. The government, number one, they want those deposits developed, but they also have secondary concerns for taxation purposes. They also have secondary concerns about the environment. They also have concerns. They want to, make sure that the locals are employed instead of, they don't want a bunch of Americans coming in and taking all the good jobs. And so, they're very conflicted with regard to mineral development because they have a different focus, and they should, because it's government, it's public property. It's like a public grazing yard for cattle. And in the United States, we are so unique, and I tell my students, and they really don't think about it, and they may not think about it much after they leave my class either, but at least they get exposed to the concept. We are so lucky to live in the United States where we own the minerals. And of course, you go back, Jason, and I've read about this. Why did the people in the United States, why did we get the minerals and no one else did? And some of the articles, one of the most humorous, did a great analysis in a 30-page of all the founding fathers' doctrine, and they said, in the end, it was probably a mistake because they didn't have any clue that oil and gas would be as valuable as it is. They didn't have a clue that we'd have, Spindletop drilled down here in South Texas in January of 1901, which actually brought in the oil age globally. And if they did, the author said, if they knew how valuable the government did, they probably would have reserved those rights to the federal or state government. And thank the Lord that they didn't for the most part. And so we can have the development and the dynamic impact because you're allocating massive amounts of capital. And of course, when you do that, when you're dealing with the government, if you're allocating massive amounts of capital, you end up with cronyisms. You end up with, bribery. You have enough issues risk-wise when you're developing as a private entity or private entities, much less when you're dealing with governmental officials and permits and payments. And that's why you look forward in the IEA, International Energy Agency, as well as the U.S. Energy Information Administration. They both think that global shale production is going to begin increasing and will peak around 2030, which is 15 or 20 years from now. But in my opinion, there's no way in heck that you will see anywhere near the dynamic growth of shale production. And as you noted, we already are seeing 3 or 4% decline or more, or 5 or 6% decline in existing fields. So if shale begins to be developed, it won't be developed fast enough really to offset some of these declines. So I think long term, the energy sector, I am so blessed that we live in the United States, and that I just sort of fell into the energy area. Actually, when I was going to school, I thought I'd wanted to work at either a gold or copper or coal mine. I got a mineral process engineering degree to figure out how to process those minerals, and it just so happens that the oil industry is so much more dynamic because instead of opening up a coal mine where you need 20 or 40 years worth of reserves, and you have to 20 or 30 or $100 million worth of capital equipment, you go out and lease and drill a well, and depends on where you drill, et cetera. But it's you can extract extract minerals and have become very wealthy just by developing the oil and gas and diligently moving forward. A perfect example is, and I tell my students, this is the only country where you get someone like Harold Hamm. Harold is the chief executive officer of Continental Resources. He grew up dead poor in Oklahoma. His dad was actually a laborer in the cotton fields, and he went to work for a gas station up in Ponca City, I think, and then started drilling his own wells on the side. And he from there, being with no political influence, with no connections, just drilling wells, he has become, a multi-billionaire. Of course, he's not quite as wealthy today as he was last July, but nonetheless, you can't, nowhere else really in the world can you point to someone like that and say, I don't think he has a college degree. And, he went to high school and said, hey, this drilling wells, I can do this. And, but he was one of the, with George Mitchell, who came into the Barnett Shale here and developed wells that no one else thought he could. I mean, Ham saw the Bakken formation up in North Dakota and said, yes, we can develop that, but instead of mainly natural gas, which we have here in the Barnett, we can do this for oil. Of course, I looked at the company, Jason, and I mean, this is a shameful admission. I looked at it and said, the Bakken's really good, but, here you have a company when they went public that, the chief executive, I mean, is not, he's very well versed in industry, but he's not, really pedigreed with, the geological or engineering degrees from Texas A&M or University of Oklahoma or some, powerhouse energy school. And I said, that's a little bit too risky. I really don't know if they really know what they're doing or not up in the Bakken. Of course, and every month I would look at the stock and hell, it'd go higher and it goes higher and it goes higher. And they did know what they were doing and they figured it out. And I've had engineers tell me, when they first got up there, it was sort of like baking a cake. You go up and, you first start drilling your laterals and you got to figure out, what type of injection fluid do you use, what type of frac formation, what type of frac program, how long do you have the lateral. And they said, every cake comes out a little bit different, even though it's a similar cake if you use a little bit different ingredients. And over time, we have become much, much more efficient drilling those wells, and the costs have come down because we figured out some of the fracking issues. And here's an example. I mean, you haven't heard this, or maybe you have. It's just the sand that they use. They figure out they were using just Texas sand and well, but they found the Wisconsin sand. They called it Northern White. If you put Wisconsin sand into these wells, whether it's in the Marcellus, whether it's in the Bakken, whether it's in the Eagle Ford, they tend to perform much better than if you use the Texas sand. I mean, some of the trade names down here are the Texas Brown, and they figured out that. So what happens is 5 years ago there were like 5 sand mines in Wisconsin. Today there's over 100, and the average well 2 or 3 years ago you used like five hopper cars full of sand in an average well. Now you use more like 50 or more because, number one, the laterals have gotten longer, but they're using more sand to prop up. And it's the crystalline structure of the Wisconsin sand. And so everybody in Wisconsin wants to be a sand miner. And I have some really good friends up there that their families are from areas up there. And they said, yeah, that's the latest, the last 2 or 3 years, if you were going to make a fortune, you convert your farm to a sand mine. And of course, the neighbors all it's an open pit. It's like you don't really mine. It's a big old hole in the ground. It's like a gravel pit, but it's profitable, and and they've done really well. But just that technology. I mean, who would have thought that, number one, that type of sand, and number two, using more of it and using more liquids also would the return on just that investment, as well as just the whole fracking program, exactly where you put in the stages of the frac program. Originally, they just did, X number of feet. You go 50 feet in frac, 50 feet in frac. Well, now you go down that lateral, and they can log it, and you get some hot shots from some of the service companies, and they can look at your log, and they can say, hey, here's where we ought to put a frac stage right here because we know this is where the rock is probably weaker and will probably respond better. And so you frac, you instead of going every 50 feet and putting a frac stage, you essentially custom design your frac program to reflect the geological formations underground there. And so, and you go that, as well as the laterals keep getting longer, how far we can drill sideways because the measurement while drilling. technology has improved so much. I've talked to some engineers that, and actually they've retired now for 5 or 10 years, and they said, you go back now, and it goes, I would go up on in some of those drilling rigs, I would just be lost like a baby. It's like it's like the space shuttle computer controls. I mean, it's essentially, they said, back in my day, it was, we're using the slide rule and, the early Apple computers or whatever. And, today it's like you're on a Boeing simulator and to direct that drill bit and measure while drilling. And so the whole technology has not only got us better so we can recover more of the reserves, but it also has increased or lowered the costs have come down. And actually, the good news about the cost of oil being $60 versus $100 is a lot of these companies that have these drill rigs, they don't want to stack them in the yard, because you stack them and it's costly, number one, and number two, once you shut it down and get rid of the crew and all the team that you use to drill your wells, when you get that rig out of storage, you have to, do new hiring, do new training, get the team together again. And I know companies, some producers, I know they've been drilling up in the Bakken, for example. This has been a few years ago, but I was talking to, some of the executives and said, there's some companies where, you get a rig and you get the team there working together, and they will specify, we want this rig with these folks because for whatever reason they like their expertise, or for whatever reason it's like a football team. It's like, hey, we get to choose the Cowboys or the Eagles or the New York Giants or whoever, and these are the guys we want running our rig because we're paying $5 million or $10 million for the whole. And it's interesting. So the price of drilling will come down. At some point, they'll clearly have to lay the rigs down if it becomes super uneconomic. But they will, and it's already happening. They're already renegotiating drilling rates downward, which is going to hurt profitability for some of these service companies short term. But longer term, they'll be back out there, and that's one area that I always was interested in, these drilling companies, the public ones, but I always have terrible timing because I buy them, they go up, and then for whatever reason, I stop watching them. The rig count goes down, and their stock prices go down, and then I turn around and, I've either broken even or lost money on them, and it's, all a timing issue. But producers with reserves, I feel a little more comfortable dealing with. So anyway, it's interesting. The technology is just where else can you use this technology that's cutting edge to develop minerals? The answer is, in the world, there's very few industries, there's very few places. And then on top of that, the capital requirements are just massive. So, you get to play with the finances too. So it's a mixture of engineering, technology, finances, ownership rights. This is a pretty cool industry. And every time I teach over at SMU, and I've been over there a number of years now, a number of students come out and said, after the class, this is one of the most interesting classes I've ever had. I didn't realize all the stuff that goes into drilling wells and how important it is, and how important oil and energy is, and natural gas and coal for that matter, to the U.S. and global economy. And this is a damn interesting area that I think I would be interested, career-wise. And of course, I don't say too much to some of the students because, quite frankly, it's a very cyclical industry. And I have pointed out to them, hey, it's fun when it's fun when things are going well, but when things go the opposite way, it can turn in a hurry, and you're at the mercy of a commodity price, which we're seeing right now, and we'll see some pretty substantial layoffs, I think, after the first of the year, unfortunately, for probably some very qualified people, both in the field as well as geologists, engineers, accountants, financiers, and actually even investment bankers they'll feel the heat. Although, Jason, I will say at $60 a barrel, there is enough interesting opportunities now that I would expect to see some merger and acquisition activity where people, they in the past year or two, they sort of sat on their hands and said, oh yeah, we're going to develop this and then sell it. Well, now a lot of folks, the cash flows might be such and the debt levels might be such that, hey, we were going to wait for a year or two and drill a few more wells and, try to sell at top dollar, but we don't have that option anymore because the bankers want their money or the stock's getting hammered. We will sell off certain properties or buy certain properties if they're your deep-pocketed, relatively large company that's well capitalized. And I'd expect some of the larger energy producers to start making acquisitions here. It might be a little bit too early now, but probably the first and second quarter, you're probably going to see some relatively large mid-cap companies get bought out because of the potential, just because of the potential opportunities that larger companies can see, and with the capital you can walk in. Now, if you look, the stock prices of a lot of these companies have been hammered. You can walk in and give a 10 or 20% premium to the traded price now, and you're still going to buy some of this stuff really cheap. So anyway, I'd expect to see that. So, but we still are going to have a substantial consolidation.
Yeah, barrels of oil are cheaper on Wall Street than it is to drill and look for and find more oil. I would definitely agree with that, especially at this point with the valuations we have now. That leads to my question here. You talked about investment opportunities. Do you think it's smart to start allocating? You manage an energy fund. Do you think it's smart to start adding to maybe oil service companies at these levels, or the larger guys like ExxonMobil, or maybe some of the master limited partnerships, which are oil service companies on long-term contracts? Do you think those are good investments, or at this point, or are you looking elsewhere?
Well, right now, I would be hesitant, and this is Jason. This is one of the reasons I would be hesitant is because, as we talked about earlier, with the price of oil going from $100 to $60 a barrel, with Russia and our sanctions on Russia and the Russian ruble being so volatile, and not knowing really, what President Putin, how they're going to respond, I'm a little bit concerned about the whole market for energy, at least for the next month or two. In the first and second quarter, and right now in December, you're probably seeing some tax selling also, as well as some panic selling. You can see people, hey, I want out of energy. I mean, I had a friend who was a broker for years out in Phoenix, and he called me about 3 weeks ago, and he said, hey, I've had enough. I sold all my energy stuff. He's 75. He goes, I just couldn't sleep at night. And he goes, with all the, and which was a great move, at least for short term anyway, and put it in cash. But the uncertainty right now, I think, is pretty substantial. That being said, depending on your time horizon, there are some really substantial opportunities, I think, when you look. And let me just mention, I invest in companies, and actually not only energy companies, but they're all smaller companies with growth potential in energy. Just because I know a lot about it, I tend to sort of like to look in there. But since the first of the year, I think the S&P, if I'm not mistaken, is up by 5 or 10% from the first of the year. If you look at the PowerShares S&P small cap energy portfolio, it's like an ETF. It's down like 40% year to date because these energy names have been hammered. And you look at that's the symbol on that is PSCE. If you look at the Select Spider Energy Fund, which is a little more mid-cap firms, its symbol is XLE. It's down 15% year to date. So regardless of which fund you're down, compared to the S&P, you're trailing the S&P by 25 to, a substantial amount. So instead of picking a specific stock, and I'm not an ETF investor at all. Because I enjoy talking to management. I enjoy, especially the geology and engineering on with regard to companies I enjoy looking at. But if you wanted and you think this is the bottom, and actually I saw some people that I respect today say they think we are very close, if not at the bottom for oil prices. you might allocate because it's easy to get into. They're easy to get out of if something comes up. These ETFs, the PSCE, the PowerShares S&P 500. If you look, small caps are generally more volatile. So you just got to be aware of the volatility. But volatility works on the upside for you, just as it cuts on the downside against you. And the select sector spider, the XLE, is a little larger companies. They're a little less volatile, but they still move. And so I think there's some substantial potential there. And actually, I may even look, in my IRA over the next 6 weeks to, I feel comfortable long term. We're going to need energy. We're going to need more energy. We're going to have a record amount of oil demand next year. And, the small companies historically have outperformed. And, the PSCE, it looks like a interesting exchange traded fund. I don't own it. I haven't owned it in the past, but I may put some of my IRA funds in it just because what you avoid is the stock specific issues like dry holes, like excess debt, the banks, violation of bank covenants, and you have a little bit more diversity, and so you get the volatility, but you don't have stocks company specific issues with regard to either the financing or even the geological province. There's arguments now. Where do you want to be? You want to be in the Bakken? You want to be in the Marcellus? Do you want to be in the Barnett? Do you want to be in the Haynesville? Do you want to be in the Eagle Ford? Do you want to be in the Permian? And you could see arguments for all of those. But in a exchange traded fund like this, you sort of would get you get a mixture of all. It'd be sort of you get your cake and all mixed up into a pudding. But those would be what I would look at. And as far as specific companies, I can sort of talk about some of those too. But let's talk about something, and I guess just philosophically wise, we have both. We've talked about oil. We also have natural gas, which is a huge shale producer. And we're going into the winter time. I am concerned about prices longer term because, as I've told my students, if you've been on the conference calls and if you visited with some CEOs of some of these companies that are drilling in the Marcellus and Utica formation, the wells that are coming in are just astounding. Astounding with a capital A. And actually 2 years ago or 3 years ago, I told, a couple of my students decided they wanted to get in the industry. The business school was a law students, and what they did is they went up to Pennsylvania and ran title on minerals and put together title opinions for companies that are drilling. And if you look at Pennsylvania, Ohio, West Virginia, those areas are going to become the Saudi Arabia of natural gas because the Utica formation is so prolific. I think Range Resources just last week announced a well, and someone sent me an email, and I won't even say the number because it was so outrageously high that I wanted to go check the press release and make sure nobody had doctored the email that they forwarded me. But I do know that other companies out there, including like Magnum Hunter Resources, Gastar, in the area have brought in wells that they thought will produce at 30 million cubic feet per day, which if you're not familiar with gas wells, you get a 5 million cubic feet per day well drilling conventional wells, and 20 years ago, and you would have thought that's a pretty good well. 30 million is like it's like you have the Indy 500 winning race car. They cost maybe 12 million, I think, to drill to the Utica. I think 7 or 8 or 9 to the shallower Marcellus. The other thing, Jason, that's really cool about up there is they have two shale formations. One is the Marcellus, which is shallower, and I think off the top of my head, and it's been a month since I looked at the stuff or more. It's like 7,000 feet down is the Marcellus. You drill through that, and then you get to the Utica, which is like at 10 or 12,000 feet down. And they're both thick formations in a lot of areas. So from one drill pad, you can actually drill multiple wells The Utica is generally, at least the companies I've followed, is really dry gas, meaning it's just natural gas and it doesn't have any liquids. The Marcellus, depending on where you're at, can have a bunch of liquids, which in the past has been really positive because when oil was $100, the liquids were more valuable than just the natural gas. But that may or may not change. But these wells that they're bringing in are just astounding. And I guess from an investment play, and I haven't found one, and I really need to look. They're going to have to build out the pipeline infrastructure, and they are up there, to connect all this. I mean, you're number one, you have massive reserves right there, and of course the Northeast is a massive consumer of natural gas in the Midwest for space heating purposes in the summer or in the winter. And the pipeline companies or transportation companies, and of course with the Keystone Pipeline, there's also been, being a lawyer. And this is unfortunate, there's been a bunch of environmental challenges to some of the development up there of some of these pipelines to get the gas from the Marcellus and from the Utica, to the main lines and to storage, and it will be done. It's more costly when you're challenged environmentally and with regard to permits and everything else. And quite frankly, I've told my students, one of the things that when the Barnett formation was being developed here in Fort Worth, they were all asking me, well, gee, would you feel bad? Would it bother you if there's an oil rig across, 100 yards or 200 yards from your house? And I said, no, really, the oil rig or the gas rig in that case in the Barnett doesn't really bother me because I know they know what they're doing. They're relatively safe. The blowouts now are few and far between. They have blowout preventers. When you're in the city, in a developed area, there's enough ordinances and regulation. They really watch. They put up actually noise curtains all over, so you can't even really see what they're doing, and it really muffles the sound. But I said, what would bother me if after they were done drilling, they found natural gas, and then they put a natural gas pipeline, through or near my property, just because even though they're using the latest technology, et cetera, whenever those blow, you're talking about, a massive amount of gas moving potentially, through and if it leaks or someone cuts, unfortunately with construction, someone cuts into it and you have a fire, it creates some real issues. But in any event, so that's the concern they have back east. And having said all this, it was sort of interesting. I saw a presentation by Range Resources. Again, these wells that they're drilling to the Utica are just, you can go look at the news yourself. But they had a plat of the Utica formation and the Marcellus and the productivity of it, and it showed where their leasehold was too. And there was a bullseye on their plat, and of all the places that you would, it's like all the places you would guess it would be, it's not in rural Pennsylvania or it's in Pittsburgh. So essentially what they're saying is, at least from according to the geological information and the seismic they've shot, is that underneath the Pittsburgh area is some of the most prolific potential Utica formation and Marcellus. I can't remember whether it's Marcellus or Utica or both. But, and I was telling you when we teach, we're talking about, the issues of just like Fort Worth, when you go and you drill in a developed area, you're going to have different issues than if you drill in West Texas where the population density is much lower. But the good news is, Lord help those people in Pennsylvania because they're all getting leases. They will get royalties. The gas has been down there 350 million years, so they're getting paid for the gas that's been trapped there worthless for 350 million years in a shale formation until 7 or 8 years ago. People would have written off as worthless. In fact, when George Mitchell was out here in Texas, everybody said he's crazy. Hey, George is drilling in the shale formation. It's like, hey, you can't make any money drilling in shale. And and actually talking about that, about 10 or 12 years ago, there's a processing facility that takes natural gas and they remove the liquids out sort of in the Barnett field area. And there was a potential for it's for investors to take that company and buy it and take it private. And one of the concerns and one of the reasons they didn't take it private, and I was sort of involved in some of the discussions, was that they didn't think there'd be enough natural gas supply, because that was before the Barnett, that the fracking and the horizontal drilling. And they said, a lot of these conventional wells are really depleting. There's not enough flow throughout here to keep these processing plants. You have to have certain gas flows to make them profitable, because you're stripping the liquids out. And they said, hey, they decided not to do a leverage buyout on the property. And, looking back, they probably would have done fine. They would have taken 3 or 4 or 5 years. But finally, when the Barnett started coming in with some of the wells that came in, and there's still a lot of gas left there. There have been plenty of gas to put through the processing plant. But in any event, it's interesting. It's been some interesting developments. But natural gas, going back to the subject, if you want to invest, one of the other things you ought to think about is maybe you don't want to be as oil-centric as everybody has been for the last 2 or 3 years. You want to be more natural gas-oriented, because natural gas prices, I don't think, are going to spike, and I think they will. I don't think they'll erode a lot either, at least over the next year, because the natural gas storage reservoirs ended the fill season in the summer below where they normally do. As we get into, and I think we're going to have a relatively cold winter, at least from the weather forecasts that I've seen that have been these guys have been relatively accurate historically. But if you buy a natural gas centric company, you might do better. And I could talk about a couple that if you want, and I don't know what your view is on natural gas, but it's a real viable market, and it's growing. I mean, natural gas is environmentally friendly, and also, Jason, most people don't realize they have a new restriction on coal emission. It's called MATS, and it's a mercury and air toxics requirement. And so a lot of coal-fired plants are being retired because companies don't want to put in the multi-million-dollar control equipment that you need to remove mercury and air toxics. And so as these plants are retired, instead of building a new coal plant, they're going to build obviously nuclear is not in the option either. You will probably be replaced to a large extent by natural gas. And these natural gas-powered utilities, number one, are more environmentally friendly, as well as just the market for natural gas is growing for heating use, as well as just with our general economy for industrial use. I mean, Lord help the chemical companies down on the Gulf Coast here, and the petrochemical. I mean, we have such an advantage. Our gas prices are a third of what they are in Europe. Our electricity prices are half. Our wages are lower, and you can actually refine some of these petrochemicals. You can actually refine petroleum, ship it to Europe and sell it, next to the plant in France or Germany, and undercut even with all the shipping costs involved and handling, undercut the European factories there. And actually, Europe has seen a half dozen refiners shut in the last 4 or 5 years just because they can't compete with, we got cheaper WTI, we have cheaper natural gas, we have cheaper electricity, we have cheaper labor. Our engineering is probably as good, if not better. It's interesting. It's an interesting sector, both the natural gas and then just sort of as a sidelight into petrochemicals.
Yeah, now I am bullish long term on natural gas. I think there's a lot of demand growth for it. A lot of other countries haven't. They're not consuming really that much oil, or they start off at a low base of oil and they're using natural gas for more heating homes and electricity in the homes and things like that. So yes, I am bullish long term on natural gas. Although you mentioned that there's a lot of supply here in the U.S. The trick is going to be to move it on that pipeline, or to make CNG engine vehicles in the U.S., or to export it with LNG outside of the U.S. So we're not quite ready in the U.S. to start exporting it yet massively to take advantage of the much higher prices in Asia or Europe. but probably maybe by 2016 we'll probably have a number of facilities online because with the permitting and the it's very expensive to build an LNG export terminal, many billions of dollars. In wrapping things up here, Joseph, obviously you and me can talk about the oil and gas markets for a very, very long time. We're over an hour here already, actually. You and me could talk about it for a long time and find it enjoyable, but our listeners, probably an hour is probably long enough for now. So let's continue this conversation another time or off the air. I just want to thank you very much for your time. Please tell our listeners how they can find your work or email you about the oil and gas markets.
Well, Jason, they're welcome to stop by. Our site is the LSGI Fund, lsgifund.com, and my email link will be on there. And it's an interesting and exciting sector, and thanks for having me on.